pose exactly that question to Dipan Mehta as well. Dipan, hi, morning. Good to have you on the show. The rains are here and it seems like the momentum is back once again, where at 18,700 seems like this time maybe we could give an attempt to that all-time high on the Nifty.
Yeah, absolutely. Good morning, and thank you for having me on your show. And as I had said many times on your show, that monsoon is the best time for capital markets. I can say that with my 30 years experience, that these are the great times for stock markets on most monsoons. And I'm very certain that this monsoon we will see the markets at significantly higher levels. I'm not just talking about breaching the previous highs. I'm talking about maybe 5-10% higher high than the previous one. These are great times. We are seeing fantastic liquidity flows coming into the equity markets, and the selling from the FIs is certainly dissipated completely. And the most important thing is that the portfolios are doing really well. The way the small mid-cap stocks are jumping up, be it on positive news flow, be it on institutional buying. I mean, there are many reasons, but by and large, I think investors are really a happy lot, and that patience has been rewarded in a handsome fashion with the kind of returns generated over the past 2-3 months.
Okay, here's some interesting data, Dipan. You just may want to be with us. What we've done is that we've looked at the P multiple, the current, the 5-year average, and the peak P multiples at which the Nifty, the small cap and the mid cap index historically have peaked out. So what we are looking at is the current multiple, the 5-year average, which includes this entire COVID cycle, and that's a reasonable estimate. And then we've looked at the period at which these indices historically have peaked out. Now, the Nifty is 1% away from an all-time high, mid cap is at an all-time high, small cap index is 12% away from its all-time high. You want to look at the P multiples, not the returns over the years. The P multiple, I think, is what is important. So, Dipan, here's how the data looks like. If one looks at the Nifty current P multiple, Dipan, it is below the 5-year average. The Nifty mid-cap 100 index, it is nowhere close to its peak and it is still below the 5-year average. And the small cap index, Dipan, is at 14.5, 12-month forward. And again, it is below the 5-year average. So can I safely say that there is a really long way to go before this market peaks out purely based on valuations?
First of all, Nikunj, thank you for this fantastic analysis. And it just it builds my conviction of very good times for small mid-cap companies and overall our equity market going forward. And I think the wild card here also is the earnings. And largely, I think because of lower inflation, raw material prices stabilizing to slightly declining, and a lot of the companies have already taken price increases in the past few months or so on the back of rising inflation. I don't think we are seeing that many price cuts going ahead. So we could see expansion of the operating profit margins as well. And that in turn leads to higher return on capital employed, and that in turn justifies higher price to earnings multiples. So I think what we have over here is a beautiful virtuous cycle of rising profit margins, rising return ratios leading to higher P multiples. And all of this, I think, is going to catapult our markets to newer highs. And I think this is the best time. I think if you have got less allocation in equity, I think these are great times. I sense that there's going to be a breakout in the larger indices over the next few weeks or so.
Okay, but like any other market peak, what we were discussing also is the intriguing factor this time around that the blue chips of the blue chips haven't quite participated yet. Be it Reliance, be it HDFC Bank, be it Infosys, TCS. Tech, of course, can be clubbed within the underperforming pack for various other reasons. But Dipan, when do we see a push coming in from HDFC Bank and Reliance?
So I think these are very large counters and they require heavy institutional flows and I think more likely FPI flows to move these stocks higher. They have been in a way outperforming, at least Reliance Industries has been, if you take a multi-year view, like 5-10 year type of a view, then certainly Reliance has been driving the Sensex and Nifty much higher. And I think that it's just a matter of time before these stocks also start to get their rhythm right. And coming specifically to HDFC Bank, I think the big event that we're all waiting for is the merger And when these stocks will start trading on a merged basis, that means HDFC is supposed to be delisted or gets consumed by HDFC Bank. And that I think will give a clearer picture of what the financials are. I think that there is still some confusion in the minds about institutional investors about the weightage of these companies within the broader indices. I think all of those uncertainties will get sorted out once we have a merged entity listed on the exchanges. And I think that could be a big trigger for the stock price of the combined entity to move much higher. In any case, I think economy is doing very well. Banking stocks and banking industry also is doing very well. The demand for credit is good. And HDFC with its brand and technology is going to be a big beneficiary. In any case, I think they have extremely attractive CASA ratios and are able to generate resources at a very low interest rate. And that's a key strength in a competitive industry like banking.
On my radar. First is Tata Com. Why do I have Tata Com on my radar? Well, the stock yesterday really went through the roof. It's made a new high, almost a new high. And Tata Com is one stock which is up 23% in June itself. Best monthly gain since July 2020. They had an analyst day where they did speak about how the data business actually could double. Now, unlike what is happening in the IT sector, Tata Com is in a position where the data and what is happening to the IT service sector cannot be compared. The data business of security data delivery in the network system, I think, is growing. And for IT companies, it's a slowdown which is happening in the BFSI space, and the cloud business, I think, is not growing at the rate at which market had anticipated. So Tata Com, in a sense, has moved out to be one of the standout gainers. The point is, what do you do now? Yesterday, the stock went up because of this buzz of MSCI, but my sense is that Tata Com now is trading above the most consensus price target for most of the brokerages. Second, the data growth is not going to be a one-quarter phenomenon. It's going to take a couple of quarters before that growth comes back. C, they will have to lever up their balance sheet. So my sense is that in the near term, best part of the earnings and the stock re-rating could be behind us. So the surge in the Tata Com may not be really lasting for a long period of time, given what they've indicated in terms of where the balance sheet is moving and how things are moving. Second, I've got SBI Cards. Margins nearing a bottom as rate cycle peaks. This is something which we should historically understand about credit card companies. When the rate cycle or interest rate cycle is strong, credit card companies will always have a problem in terms of margins. Unlike banks where they benefit when the rate cycle starts, especially the large banks. In credit card, I think it's the reverse. SBI, I think SBI card has been in standout franchise there. Their book, I think, is of excellent quality. The stock was the haloed stock. It's not really the haloed stock now. And then if one really looks at the CAGR growth of the industry, the retail digital spend, I think, is growing at 47% and is projected to go at 30%. So I think this really could be the dark horse going forward, looking at where one of the big beneficiary of the rate cut cycle would come. So Dipan, I'll take my chances. Tata Com stroke SBI Cards. You track both of them, none of them, one of them, you can choose.
I track both of them. I have invested in SBI Cards, still remain invested in Tata Communication. I had invested for several years, and then I threw in the towel because the returns were just subpar. You know what is the common thread between both these companies? They have both lived below their potential. Tata Communications, I think they've been talking about this data story for many, many years. Rise in data traffic is not a new phenomena. It's been there right from last 4 or 5 years or so. It's been picking up. And there was a beautiful opportunity during the COVID when data traffic really shot and went through the roof. So many more new applications went onto the internet, and we had the Zoom calls and the OTT, the proliferation of OTT channels. That has all led to higher data consumption. But look at the way Tata Communications data business has shaped up. It is still in that low to mid single digit type of volume growth. Margins also are pretty much flat. From time to time, they do talk about this business and how it has the potential to scale up, but it always disappoints when you see the actual numbers on the ground. That is as far as Tata Com is concerned. SBI Cards also, for some reason or the other, has not lived to its full potential. Sometimes it is the revolver lending that has slowed down. Sometimes it is some exceptional provisions which they have to make. something or the other is not going right for SBI Cards. But I have more hope in SBI Cards than Tata.com at this point of time. And one point in SBI Cards, which perhaps has been missed over here, is this linking of credit cards to UPI. So if you have a RuPay card just now, you can link it to your UPI, and every time you make a payment, instead of it hitting your savings bank account, it will go and hit your credit card. And that way you can earn points and get at least a few weeks of credit on the spending you have taken place. And as and when they get Mastercard and Visa also on the UPI platform, that will be a very big positive trigger for all credit card companies. And credit card business per se, I think globally also is exceptionally good business and with very high net interest margins and good volume growth as well. So very positive on SBI Cards. Again, a disclosure here that we and our clients are invested, but not so much on Tata Communications, only because of its track record.
Wanted to ask you about a couple of breakout counters that we saw yesterday. Laurus Labs, as well as we saw quite a bit of surge on macro tech developers.
So Laura's Lab, this is the third consecutive month where stock is forming higher high-low formation. It clearly suggests that the stock has completed its base formation from oversold territory. Now stock is in recovery mode. So looking at the setup for near term to short term, we believe that Laura's Lab continue further more upside as the breakout is clearly there on the weekly as well as on the daily chart. We expect a target of around 395 to 400 in the continuation of this pullback rally which we are seeing. One can buy this stock also with stop loss of 345. Macro tech developer, a very strong breakout we have witnessed in the stock. Most of the stocks from that segment is continuously moving up, and the stock managed to give breakout of its multiple supply zone on the weekly chart. So looking at the chart pattern, if stocks continues to hold above 640 level on a weekly closing basis, then possibly next target for the stock could be around 750 to 800 in the continuation of this uptrend.
Okay, Rajesh, so that's the take coming in as far as Lodha and Laurus Labs is concerned. We let you go on that note. Appreciate you joining us on the show. But Dipan, I wanted to come back and speak with you about the entire QSR space. Yesterday as well, we saw quite a bit of up move on the likes of Devyani International. Sapphire Foods is also coming back. Is this a space that interests you?
Absolutely. Again, a disclosure here. But what we like is that this is the new FMCG stocks. I think when you want to play the consumption pattern, then the QSR industry is a perfect play on rising consumption, changing habits, changing tastes. And also, I think the runway for growth for these companies is phenomenal. The balance sheets of most QSR companies also is in solid form, so which means that they can keep on adding to the distribution network without too much of a burden or even taking on debt for that matter. They have free cash flows to support any expansion. And these are going to be great businesses 5-10 years down the line, purely on account of delivery, on account of new restaurants which they will open in tier 2, tier 3. And look at the way I think the highway network also is shaping up within India. I think that's a huge opportunity for QSR companies. As more and more Indians travel by road, there will be requirements for more and more such pit stops where you can have these QSR restaurants, as we have seen in the developed countries. So very positive on these on the sector as a whole. It is a bit expensive, and we have to admit that last quarter was definitely soft for the industry because of a lower consumer demand. So I think it will have its ups and downs. There will be minor cycles within cycles as well, but the long-term trajectory is very good for QSR. And I think if you remain invested with a longer term view, 3 to 5 years or so, these stocks could certainly give fantastic returns, at least outperforming the benchmarks.
So the long term, talk to you about a sector that we usually did not, and that is the entire power space. It's coming back into action. We have seen decent amount of rally in these names. Would you look at these names as a long-term bet and the entire energy transition theme?
See, I think power companies clearly are in the focus because of rising install capacity, and almost every single power utility is looking at increasing its footprint by adding more and more renewable capacity. NTPC, I think, is an interesting case. We are seeing a lot of interest in PSUs. NTPC has been a multi-decade underperformer, but now I think with the way the demand for power is shaping up, and that company also is looking at aggressively expanding its renewable portfolio, and that should certainly drive higher interest in the stock. So from a purely valuation perspective, and especially if you have a kind of a value strategy, then NTPC should do pretty well for you, at least give outperforming returns. But by and large, I think these are utility companies, and one cannot expect some multi-bagger type of returns from these stocks. And our focus right now is more on growth companies. There was a time to buy value companies maybe 2-3 years ago, so and they have done well. But I think this next phase of the bull market will belong to the growth companies. So we're looking for companies which can grow 25-30% or so top line, bottom line, small, mid-sized companies within the sectors, chosen sectors. I think those will give a significantly higher return, and then there is scope for even exceptional returns due to stocks doubling, tripling also.
A couple of those ideas, the high growth companies, apart from the ones that we've already discussed.
Yeah, well, I know the minute I said this question, I knew the next one was which were the high growth companies. It's like a bit like putting
You
your foot
baited
in the
us
mouth.
into it, Dipan, pretty much. You baited us into it, so now tell us the names as well.
See, there are so many, compliance issues over here. And again, disclosure, I must have said it many times in this interview. But we like this entire capital goods space. And two companies which come to mind, which are quality players over there. One is Praj Industries, which of course is pursuing the ethanol opportunity. And second is VA Tech Webac, that's been also moving up, scaling to new highs. We all know the importance of water. I think it is front and central with every agency, state, central, as well as private sector. And VA Tech Webac is a quality player in water projects. They have an international footprint as well. Both the valuations, I think, compared to the business dynamics are reasonable, and they are sitting on multi-year order book positions, which we like. So I think there's good earnings visibility as well. But again, I think, these stocks have run up. One must, be a bit careful and do their own due diligence before investing in them. But like that, I think there are many such engineering companies. I think Triveni Turbines comes to mind, ISJEC comes to mind, I think, which are available at reasonable valuations, but have great potential in terms of the way the capex cycle is shaping up, with private sector also now getting into the act.
On that note, we let you go. Thank you so much for joining us today and talking to us about a whole host of sector. But remember,